the 50K is worth less next year, but also what you can buy won't be as good because things are growing and we're on an upward trajectory. Hello, hello, hello. This is another episode of the Wealthy podcast with Louis Heaton and Sam Assad. Gentlemen, thank you for joining me today. It's lovely, bright in Sydney, so I think that lifts the energy a little bit. How you fellas doing?
Yeah, I'm well, Dom. Yeah, well.
Good.
Good. Okay. Well, today we're talking about how you can invest $50,000 into the Australian property market, and I guess whether or not you can and what you can get for $50,000. We have mixed opinions about this. Some a bit more optimistic or pessimistic about what you can actually do with $50,000. So, let's kick it off. Before we jump onto what you specifically can go and buy, let's have a quick chat about the general property market at large, what's been happening, the results that we've been seeing. I want to just lead with Sydney is absolutely soaring. So it's soaring further and further out of reach of many Australian investors, particularly people that are here. So I must say that, 50K in Sydney is looking pretty grim. What do you guys think about it? Sam, can you buy much in Sydney for $50,000?
An income-producing asset? Absolutely not. Maybe a parcel of land, regional, somewhere far out, 300-400 kilometers out, maybe.
400 kilometers.
But you definitely need a dwelling to be built to have on top for you to make it a sound investment. So in a nutshell, I'm going to say no. You're out of Sydney.
Yeah, you're out of Sydney. Do you agree, Louis? The market has been running at, let me just pull this up very quickly. The annual return for Sydney is 18%. So that $100,000 or $500,000 property is basically up to $600K. What are you buying for $50K? What are you doing if you're trying to buy property in Sydney?
Nothing. You can't say nothing. I think I've seen properties being bought with under $50,000. They were utilized the NAB 5% deposit scheme.
Yep.
It was a one bed, one bath in a western suburb. I think you can't buy. There's nothing worth your $50,000 in Sydney at the moment. No, I think if you're buying something that's just for the sake of buying, I think you're losing.
Yeah, look, I do agree that it's pretty grim. The only way I can see someone getting into the property market or in Sydney property market with 50K is you're a first home buyer, you're not paying stamp duty, you're getting government grants, and you're probably buying a one bedroom. The only other way I can see you doing this is if you're doing a delayed deposit, you're negotiating with a developer and doing something tricky like we tried to do, where you're doing a stage deposit, so 5% up front, and you've got some time up your sleeve, so you can wait that 12, 24 months to go and save up the rest of your deposit. But even then, the lending situation is grim. I wouldn't want to be going in trying to get a 90% lend as a first home buyer. You're going to have to talk to mum and dad or get a guarantor or get a loan or beg, borrow, and steal to get into the market. But, enough about Sydney. Let's talk about what you can go and get in. Let's start with Melbourne. Sam, what would you go and buy? What can you go and buy 50K deposit in the Melbourne market?
So I just want to say that I'll have to echo what you just said, Dom, as well. So the only way you can get into the market if you're capped at 50K is that you're milking all the government's incentives and you're a first home buyer that is going to get away with stamp duty. Because if you are that purchaser, we do have stock currently with Wealthi at the moment. They've got townhouses at 450 to 470,000 that all you would need is a 10% deposit. But there are purchase costs that are involved. But optimistically, what you can buy is probably a townhouse out west that's around that sub 500K range, or you probably will buy a one bedroom you probably need to buy a a 1 bedroom in inner city. 5 to 8 kilometers out. There are some that have got a nice magical 4 in front of it. So that's really about it between the both. So either a townhouse further out from Melbourne, or if you want something in a city, you probably can find a 1 bedroom apartment, and lucky enough with a car space as well.
So before we jump over to Louis, because I know that you like the Melbourne market, what's that townie look like? Is it a good investment? Do you feel satisfied? With someone just kind of scraping the bottom of the barrel? I know some of our clients, they are scared to go and just invest the 50K. Like, what am I actually going to get? Is it a good investment, or am I just scraping in?
No, actually, everybody thinks because you're at the bottom end of that of the budget barrel that you're probably going to get some dilapidated old 1 bedroom, needs a fixer up or whatever it might be. In fact, the one that I just mentioned alone is a 4 bedroom, 2 bedroom with a single garage, investment. So on that front, to find something at 4 bedroom closer to the city, you'll probably be paying an extra 200-300 grand for it, but you're not in this case. So I think it presents some good value if you are entering the market and you are capped with a budget. So I think it's a really good stepping stone to dip your toe in.
Yeah, I agree. I asked the question because other people that are obviously listening.
Sure.
Do you echo those thoughts, Louis? How are you spending 50K in the Melbourne market or Victoria?
Yeah, exactly. It comes at a 5% deposit, probably to negotiate a 5% at settlement or a delayed deposit, but without repeating Sam for a couple of minutes, it's exactly that. Like, you can't. I think the one thing we have to do immediately as an investor is lower our expectation of an asset. I think people with $50,000. I mean, $50,000 isn't a sum of money to be shun over that saved. $50,000 in the property investment market isn't a lot, but it takes someone 10 years to save $50,000 more. So it's hard work to get to that savings point, and all that hard work it might put your perspective in a place of buying a big beautiful house, but it's simply not the case. And I think that we have to lower our expectation of the asset first of all, but there is still opportunity to buy an investment itself.
It's interesting. You're right, because so much goes into saving that deposit, and you spend a lot of time hoping, dreaming, thinking about all these different possible opportunities that are out there in the market, because you spent 5 years or 3 years getting to 50K. Then you start looking and you realize, holy crap, the market's run. I can't actually afford anything. So you're faced with two choices. Do I keep on saving at the rate that I've been saving and get something that I want, and I'm going to compensate a lot, but I'll probably like? Or do I just go and, manage my expectations, get into the market, buy what I can, and ride the market to use that equity and buy the next thing? I'm very impatient. Like Sam says, he flushes the toilet before he finishes. It's giving too much away, but I'm impatient. So I'm very eager to get into the market, to use the 50K, to work it, let the market run, and use that equity to buy something else. What are we going to go buy if you don't want to buy something in Melbourne? It just feels a bit weird, and you don't want to buy a 1 bedroom in Sydney, and you can't get money from mum and dad. What are the other options?
50K, 50K deposit, 5% now on exchange, 5% at settlement. You can get a 2-bed, 2-bath, 2-car in Canberra, 2-bed, 2-bath, 1-car. 10Ks out of the Canberra CBD, light rail, great connectivity, amenity. And I think it's a time. I think the spread between the Canberra apartments and the Canberra housing market is getting to a point where there must be we've spoken about this and we don't want to harp on it, but we've spoken about this in other podcasts. We're getting to a point where that gap must close. And I think there's an opportunity there. But yeah, if you split your 50K up and we look at something that's $500,000, I think you put a 5% deposit, 25K down. It might be 8 months away. It might be a year away. you put that other 25K in your savings, and you let that grow up a little bit to save up for your stamp duty payment, which is payable, at settlement. And then you've got a 2-bed, 2-bath investment on your hands in a market that's going to run and it'll move probably a lot during the time you've put that deposit down.
You said something really important there. And I want to just point out to people, let's not turn your nose up at Canberra just because you don't know it or you're unfamiliar. There are now 3 markets that the median house price is over $1 million. Sydney, Melbourne, and Canberra. Canberra ran at 20% year on year so far, or for the last 12 months, has run at 20% price growth. A lot of that has gone to houses. The units haven't moved really at all. We had Eliza and Owen from CoreLogic put out a report and showed the spread between the houses and Canberra apartments is massive. Houses are 75% more expensive than the apartments. That is due to the fact that the Canberra market has produced thousands of units through some major developers like your Geocons and APGs and a few other groups. But one thing that I think is critical is the market. The amount of units are being spread across different geographic locations that will slow down, and population growth in Canberra will keep on going. And at some point, people are going to say, hey, these units are way cheaper than houses. I want to be in Gungahlin, I want to be in Woden, I want to be in one of these markets. So that's a real steal to me. 2-bed, 2-bath, 1 car, $500K. Give me one of those instead of, a house that's over $1 million. What do you think about the Canberra market, Sam?
Look, Louis, the Canberra expert here, but I just want to say that if I was to choose between $1 million home or outlawing $1 million or getting to a growing market like Canberra and getting value of 2-bedroom, 2-bath, 221 or 222, to me, you would rather get, it's not the quantity, it's not the value of something that you're buying in terms of size, but it's something that an investment that's going to grow long term. So, and I have to say that I think that's where Canberra is leading to, where it's been the underdog with the reigning cities like Melbourne, Sydney, and Brisbane. But I feel like it's got its own merits, that it's catching up. That it used to be the forever 4% a year, and I feel like it's gaining some really good ground, and it's becoming quite tenacious in the fact that the yields are really, really sexy. So, and I feel like the capital growth is going to match in the years to come.
Yeah, the yields are sexy. I will say that I do like the yields there. It's not many markets you can go and rent a house out for $1 per thousand. So $500K, you rent it out for $500 or more per week. And when you're locking in interest rates at 3% or less, you're making money from day one. What more do you want from your investment?
I agree.
And let's go to the what has been an ugly duckling for many, many years, the Brisbane market. What are you fellas spending $50,000 in the Brisbane market? Do you like it? Do you believe in the story? What are we buying? $50K. Let's start with Sam, because I know that you've been looking at that market for a while now, and you've got long experience in that area.
Look, I'm slowly becoming a big converter, in the Brisbane market, and obviously now there's that hustle and bust with the Olympics. That's now been confirmed, which I believe is also a driving factor in market growth. There's always, that simmering hot anticipation of something to happen, and I feel like there's been past examples with other cities that have held international events like that, and people have sought interest into, and I feel like that's also part of the drive of people getting into. But what really is starting to interest me about the Brisbane market, putting aside the Olympics, is the fact that the scarcity of owner-occupiers wanting to be in certain pockets of Queensland itself, presenting a really good lifestyle. It's already known to have this coastal, very chilled, relaxed, environment. But I feel like now people are latching on to, buying into there, living in there, putting aside Melbourne and Sydney where it's on a faster pace. I feel like that is also driving people to go up north and spending some money there and having families and living there.
You said a lot of really important points. I just want to unpack a few of them.
Okay.
One was the fact that the Brisbane Olympics is coming, right? That's huge.
Yeah.
And if you have a look at the data from the previous Olympics and the impacts that they've had in both like world cities and developing cities, you're looking at price growth in excess of 40, 50, 60% over a 7 to 10 year time period, which is nothing to sneeze at, right? That's a huge amount of growth.
Massive.
Like you buy a 500K property, you've made, if it grows 50%, it's $250,000 on your original investment of say 50 or 100K. That's a huge return. The other thing that I thought that you said was very interesting is migration. Everyone's running out of Sydney, running out of Melbourne, going up to Brisbane. And this whole COVID environment has allowed us to work from home, do digital sessions like this. Now, suddenly moving to the Sunshine Coast, the Gold Coast, Brisbane, you can go buy a nice home for $500,000 to say $800,000, live near the beach, and have a really good quality life. Has become a palatable choice. People are choosing to do that. So there's a really strong owner-occupier demand up there. And I guess therein lies the opportunity to get the sort of short, medium, and long-term growth. But Louis, what are you going to buy with 50K in Brizzy? I know that you've got some clients now buying some nice packs.
I think you got to buy land. Like it's a no-brainer. If you're going to go to Brisbane, you've got to get a piece of land content. I don't think there's value yet in the apartment space or the closer city ring townhouse space. I think you have to get a piece of land. And that's simply an opportunity that you can't do in Sydney or potentially Melbourne with 50 grand. So if you're going to use 50 grand and you're stuck on Brisbane, or you're going to look at Brisbane, you have to get a piece of land that, and 50 grand could get you a piece of land upward of sort of 400 square meters. So that's a nice piece of land, brand new build. But that's the thing I'll be looking at. And that's probably the only thing I'll be looking at if you're going to be wanting to invest in the Brisbane market.
And is there a risk there? I mean, let's just call a spade a spade.
Of course.
House and land, sometimes you've got this valuation risk.
You're going to get valued bad. And that's, I was speaking to a few developers and a friend of mine up there, and he said, it's normal for 10 to 15% undervalued straight away. He said that's, and
40K under.
He said that's sad. So for example, we had a property that was valued about 20K under, and it was worth, what's that? 400 grand. So that's 5%. Is that right?
5%. Yeah, 5%.
5%. And then he said that is, he told me he was stoked by that. That's an amazing result. He said value is up here. They're not doing the right thing, but that's just the going market rate at the moment. Sort of 5 to 10%. And in some cases, if you're not getting enough bathrooms, it hasn't got a value, it can't look at it. You got to put your best foot forward. 4-bed, 2-bath, 4-bed, 3-bath, 2-car. Big land component. It's probably putting your best foot forward to see valuations come in on a good level in a suburb that has good connectivity, amenity. It's a sort of established community. But I think that the trap in Brisbane at the moment, cheap. It's very cheap, and cheap is cheerful, but in that particular market, cheap isn't better. I don't think you can go and spend 350K on a property, because the gap you're going to make up with the VAL and everything else, you're going to eat up your 50K pretty quick. But if you go spend somewhere near 450 and you got a really strong chance of the VAL coming in on contract price, I think you might go over a little bit of your 50 grand, but that's a better investment, I would say.
Okay, so you just got to tread carefully when you go into the Brisbane market.
Very much so.
Because, valuers are what they are. I've had my experiences on completely irrational valuations. I had a property that had 3 valuers come out. One came, 20K under, one went 30 or 40K over, and one went like 100K over. So that was odd. I took the 100K over one, just in case you're wondering. That's because I was revaluing the property to go get some finance unlocked from the property to then go buy something else. Nonetheless, look, I think that this valuation issue is a thing, and I do believe in the Brisbane market. There's certainly opportunity everywhere. You've just got to be careful.
And you've also, I reckon,
you've got to be careful.
You've got to have a really good mortgage broker, Dom. You might have an established relationship with your brother's partner might be a mortgage broker. Your best friend might be a mortgage broker, but I think you got to speak to a broker who's done the Brisbane market before, done the house and land pack options, or done whatever your investment may be before, and is familiar with the banks and what's happening and up-to-date knowledge. Because I think when times do get tough, and they will when you're buying something up in Brisbane, it's easy to roll over and it's easy to say, or give in to the valuation or give in to the circumstances. But some brokers won't, and some brokers can manage expectation as well. So
that's a good point, because for all of you listening out there, all brokers aren't made equal. Some banks have an appetite for an area and they want to lend money there. Some banks don't want to lend money there because they're overexposed, and they will choose the right valuer. They'll choose to make the lending requirements more difficult, and they just won't want to give you the loan. So it does make sense to work with the right broker. And please listen to me. If you're going to take something out of this, when you're choosing a broker, the interest rate isn't the most important thing. Getting the loan is the most important thing. And then after that, all the other stuff follows. But you got some experience working with good or bad brokers. A little bit off a top topic, but I just wanted to touch on that.
The way I see mortgage brokers, there's a lot of them out there. And there's ones that say they're experienced, and then there's ones, that work directly for a top tier bank and will give you a one product solution. So if you are listening, you need to find a mortgage broker that's a solutions-based mortgage broker that's got access to 40 to 50 funders that will find the correct scenario for you, the correct structure that works personally tailored to you. So don't be disheartened if, say, you go to a mortgage broker from a specific bank that says no, because they might not suit you. But other funders would love your business, and people want to work with you. So, and that's something that I've seen in my experience in the last 10 years, where I've seen the good and the ones that have just done a 6-week course and are telling you they can't help you. So be wary of that as well.
All very good points. So just to sort of round out this 50K coming into the market, if you're out there, you've got 50K, one thing I want to tell you is you've got to be ready to go to war. It's not going to be very simple for you. And you've also got to manage your expectations, because 50K is a lot of money in some ways, because you can buy a hell of a lot of shoes, you can buy a car, but there's not a lot of property you can get with 50K. So you have to lower your expectations, be prepared to travel, or do things that other people aren't willing to do. Do a house and land pack, work with a mortgage broker, fight with a bank, negotiate on a contract, maybe buy with a friend or partner, ask your mum or dad to go guarantor, use all the government grants. There are things available to you if you're spending $50,000, but you've got to muster more courage. You've got to be a lot more thick-skinned, and you have to fight a lot harder than someone that's sitting on their laurels and they've got 300,000 or 400,000.
Agree.
Okay, so gents, we've got to go across to the UK market. We're going to get Chris, our UK correspondent, to just give us a breakdown on what's happening in Europe, the UK. I love hearing what Chris has to say. So over to you, Chris.
Quick update from the UK on what's been happening over the last week. So as I touched on last week, the pandemic has really shaken the market up in terms of buying and selling. National house prices are still on the rise, and there's really no sign of them slowing down just yet. When we're looking at the rental market, and in particular in London, it's been somewhat different. Rents have been dropping over the last few months, and demand is down year on year in Q2. West Central and West London have seen the biggest drops, and they're both down 4% when compared to last year. In terms of specific areas, Chelsea saw the largest drop of a whopping 15%. Earls Court saw an 11% drop, and Dulwich recorded an 11% drop as well. And then it's interesting to look at it when you exclude London from the equation and look at the UK as a whole. And rents across the UK actually increased by 1%. So I think as the vaccine continues to be pushed out at the rate that it is pushed out, and the nightlife returns, the nightlife and entertainment industry returns to these capital cities, more so London and Manchester, Liverpool and Birmingham. I think we'll start to see a shift in the younger demographic returning to these capital cities. And they'll be able to find work and the industry is back and pumping. I think that'll really start to increase the demand for rentals in London in particular. And we'll start to see a reverse in the current trend that we are experiencing over the next few months. And I think in the build up to Christmas, when it starts to get busier, we'll start to see the trend and the demand for rental start to go through the roof. So hopefully we stay on track. Hopefully the roadmap out of these COVID restrictions stays on track. And we'll continue to see some very positive signs from the UK. I hope you guys have a great podcast and we'll speak soon. Thank you. Bye.
Chris, that was a really interesting breakdown. Thank you for doing that. It's weird to hear that some markets are dropping in value or have had that dip, particularly in the rental market. It's interesting to hear because we have had a similar circumstance in our major metropolitan hubs. So cheers for that breakdown. We appreciate you giving us the heads up on some particular areas. Gents, let's go to our listener question. We've got Christine from Instagram who has a question here, and it is: what are our thoughts on entering the property market with a 5% deposit?
I think that's a good question, but I think that's a question that only a mortgage broker should really genuinely answer, because they can really give you an understanding of affordability and what that means from a perspective of, a borrowing standpoint, what it will cost you, and what that really generally means to you from a risk point of view. Because there are flexible developers out there that do accept 5% deposits and happy to take a 5% deposit. But I really think it's more so, you being to understand your own personal, say finance scenario, what that generally means for you.
Yeah, I agree. It's an interesting point you raise there. Just because you can sign a contract with 5% doesn't necessarily mean you're going to get finance at 5%.
Yeah.
What do you think, Louis?
No, it's a question that we get asked a lot. I think that people can be confused with exchanging on a 5% and then also getting a loan for 5%. So it's as what you both said, it's a question for your financial advisor, question for your mortgage broker to see where your capacity to borrow is. It does seem that getting in for a 5% deposit to a property on as per exchange is really good because it lowers your barrier to entry. But there will be, if you don't look into it carefully, there'll be consequences when it comes to settlement.
Yeah, it's a good point. I really like the idea of getting in with a 5% deposit, provided you know what your exit strategy is.
You like debt though, Dom, so...
I do like debt.
That debt's your friend.
And you want to be able to manage it, understand what your costs of that debt are and how much income you're going to receive. But I'm also okay with 5% if I've got enough time to save the remaining 5, 10, 15%.
100%. Agree.
If we've got 3 years and I really like the asset and it makes sense, then sweet. Here's 5%. I'll wait. The market's going to rise, or I believe that market's going to rise, and take the money because I've got a position on a good asset. It's almost like having an option on a property, and Sam knows more about options than most. And if you believe that the asset's going to rise and you can secure it with a 5% deposit and you can save on your way through, then I think go and look at it, do it. But certainly go and get financial advice and talk to your broker and find out how the hell you're going to go and settle on the property, because you don't want to walk away from that sum of money.
True.
Okay. Guys, that was a good show. We got to have a lot of good conversation about what you can do with 50K. Any parting thoughts, Louis, that you want to leave to our guests and people that are listening?
No, I think that the discussion around the $50,000 mark, I think it's a sum of money that is very. We hear a lot today for your first time investors. We hear that 50K, whether or not they have 55, whether or not they have 45, there seems to be average of $50,000. And I think what my opinion is, when you start to when you're saving on your way, I think when you hit the $45,000 to $50,000 mark, your brain almost opens up. Okay, I can start thinking about property, or I can start thinking about buying. I've got enough money to buy property. But I think the thought should start way before then. When you get to $25,000, $30,000, start thinking about what we can do with 50 when you get there, because there might be some schemes, there might be some ways to get in and maneuver your way in. But it just might mean that you have to get your ass into gear once you commit to something to save that extra bit of coin.
Agreed. Sammy, parting thoughts?
Yeah. So if there are options that $50,000 that can get you into the property market now, chances are that $50,000 next year won't be as valuable as it is today. So, either you do something or you wait, and take the procrastination route, I guess, and see the dollar just devalue and you being further outreach from a property purchase.
Listeners, if you're going to take one, or people watching, you're going to take one thing out of this, your 50K is going to be worth less next year. Quote from Sam. Jenny, can we wrap that one up and have like a meme now? Because he's right. The 50K is worth less next year, but also what you can buy won't be as good because things are growing and we're on an upward trajectory. I suffer from FOMO, so I don't know how the hell all of you save to $100, $200, $300,000. As soon as you get to 50, get into the market, start talking to the team. Thank you very much for listening to the show, watching. We're trying to get up our subscribers, so please subscribe, send it to your friends, make sure they click it, even if it's just your mum and dad and family and cousins or whatever. We really appreciate that. Have a lovely day, stay safe, and we will see you next week. Catch you all later.
Au revoir.